Hi, in this video we are going to analyze backtest results using Equities Lab. We are going to click on the Create Stock Screener, and from this menu we will hit the Editor tab. We will start off with our usual 0 to 10 price earnings ratio. It's a good value screener, but we will go a little bit more in depth than we have thus far. We will set a dividend yield to be greater than 0.03 or 3%. However, it did not like something that I typed, so dividend yield and 0.03. Okay, and if you just hover over dividend yield, it'll say dividends per share over the trailing 12 months divided by price, expressed in number. So I just use the 0.03 as my percentage ratio. I add in another dividend yield, and this time we're going to say 0.1 for 10%. But we want it to be less than 10%. So is to pay out a dividend, but not so much that we're crippling the growth of these companies. And here we're going to look at a momentum factor. Momentum factors have been shown on average over time to produce fairly good returns. The concept being that you are picking winners and they will continue to win. So we type in close for our closing price, the last trading price of the day. But to do this we have to click on close because we're looking at a ratio of 2 closing prices. Hit the divide button and then hit return, and that sets up our formula for our screener here. Now in this particular instance, we need to do the x as of in days ago function. So that lets us set our close price as of 252 days ago, which is the number of trading days in a year. And we want to set that to be greater than 1.2, or basically that the closing price today compared to the closing price 252 trading days ago is 20% greater. And that is the logic behind the momentum factor. So we click the go button, and just like that we are presented with a much more manageable set of companies. However, we are still in a very narrow time frame, so we switch that to 10 years. And now we are looking at our companies and the returns on those companies for the ones that we're still holding. Then we will backtest. Hit the run button. And we get our results from the backtest. For some reason the default for the backtest was 10 years, and you change the date, or for 5 years rather, and we change the date to 10 years and run the backtest again. And after our backtest is finished, here we can see the graphical representation of what our trading strategy has done. And click over here, it looks like we're at 202.3%. So if we invested $100 at the beginning, we'd be sitting at about $302 today, compared to the SPY where you'd have $210 roughly. From here we can go to our trading rules and go from a weekly rebalance to a quarterly rebalance, and again click on the backtest button to run our backtest. Once we've done that, we can see that things have changed a little bit, actually decreasing the return that we saw in the previous example. And you can click, just about anywhere you want to kind of see what's going on at that point in time. So if we go down here and say show stock screener as of this time period, it's going to load up the holdings that we had. You can see here that one of our largest holdings, we lost 53% on it. These other two did well, but at that time we were only holding 3 companies, right? In any case, we can go back to our results tab for the back test. And from here, we can see that we have our backtest table. And our backtest table is going to show you all of the data that the backtest graph was based off in the first place. Again, you can export this to Excel to manipulate how you wish. Another interesting tab here is the backtested by time tab. With this tab, we can compare year by year, instead of the cumulative effect, the yearly returns of our benchmark compared to our screener. So we see here that in the first year we actually underperformed. In the second year we outperformed, so on and so forth. We had a few really bad years during crisis, a good year, a poor year, followed by some decent years, and one poor year, and then year to date we seem to be outperforming the index pretty heartily. We can also click on our positions tab here, and this gives you an idea of what companies have held at any point in time during that whole screener. So from 2005 to 2015, this shows all the different stocks that we've held and the returns that we've saw on those particular stocks. So at the top, it even gives us our average return for these different sectors. Here, asset management category is a negative sector. Let's see if we can find another bad one. Oil and gas integrated category is bad. I believe that's not entirely surprising. And it may be something that you might want to control for when you are setting up your particular screener. And then if you look at the financial services here, we can drill down on that a little bit, and we can look at our different categories here. A lot of times you will find that within these categories you have actual ETFs floating around, and the problem with having ETFs floating around is that they have some strange financial ratios that you wouldn't consider in the same way that you would consider other companies to have strong or weak ratios. And that goes for financial companies in general. If you think about a savings bank, for example, deposits are considered a liability, and even though that is the very money that the bank makes money off of, so in a certain sense it's also for them a type of asset. So later on we'll show you how to screen out the financial services companies or any other sector in particular that you feel like you don't want to have in your trading strategy. But we are going to leave you with that for now.